Hello, everyone. Welcome to this Scientific Portfolio webinar. It's a pleasure to have you here. My name is Shahryar Safai. I am Scientific Portfolio's Deputy CEO, and I am delighted to introduce you to our main speaker today, Vincent Bouchet. Hello, Vincent.
Good afternoon, everyone.
Vincent is our Director of ESG and Climate Research. And before joining Scientific Portfolio, Vincent worked for the French Ministry of Economy and Finance on public policies related to climate and biodiversity. And before that, he was working on the integration of climate risks for a leading asset owner. So before letting Vincent present his latest research today, I will spend a couple of minutes presenting a Scientific Portfolio, and then we'll hand it over to Vincent. One sort of question perhaps is you have a Ask Question button on your dashboard. Please feel free to click on it and send the question throughout the presentation. We will try to answer them all at the end of the session. There will be a Q&A session. So Scientific Portfolio, we are a technology venture incubated in the research ecosystem of EDHEC Business School, and we provide investors with a platform to independently analyze and construct equity portfolios, both from a financial and extra financial perspective. That means we cover both performance and risk aspects, but also ESG and climate considerations, all into the same platform. The main sort of value propositions of Scientific Portfolio are, on the one hand, an independent opinion. So it's a intuitive and independent platform for analytics and portfolio construction. We bring a dual expertise, both financial and extra financial, brought together into the same framework. And finally, with EDHEC Business School being bringing out our DNA, with our academic DNA, we have a lot of research and educational content, both embedded in the platform, but also outside of the platform, like the piece of research that we will present to you today. And with that, I will hand it over to Vincent. Vincent, over to you.
Okay, thank you very much, Shahryar, for the introduction. So, okay, I'm just a little bit new to the platform. Just wanted to make sure that we are currently on the right slide. I still see the first one.
Okay, I can move to slide 5 if you want me to. Yeah.
Yeah, I think I prefer, because at the moment I'm still on the first one. So if you can do the move, it would be perfect. Oh, that's okay. Now I move to the 5th. Perfect. Okay, I'll try to. Okay, so good afternoon, everyone, and thank you for attending this session. Today, I'm really pleased to present the results from one of our latest studies, titled "Do ESG Scores and ESG Screening Tell the Same Story?" This study has been done by the Scientific Portfolio research team in collaborations with Mathieu Joubrel from ValueCo, and it deals with the informational overlap between ESG scores and ESG screening. So I will go first a little bit, present a bit the motivation of the paper. Why did we investigate this question? Then I will spend some time on the underlying data, especially the ESG data. And of course, I will then present the main results, and I will finish by some practical recommendations. During all the presentation, feel free to ask your questions in the chat, and we will both try to answer them at the end. Okay, so why did we investigate this relationship between ESG scores and ESG screening? According to the last sustainable finance figures in terms of assets under management, both exclusionary screening, whether it's norm-based or negative exclusionary screening, and ESG integrations are among the two most prevalent sustainable strategies. However, they both rely on different ESG data. And so our initial hypothesis was that it could lead to inconsistent outcomes. By outcomes, I mean inconsistent portfolio allocations, for example. So the goal of the study is to investigate whether these two approaches overlap or whether, on contrary, they provide distinct and complementary results and perspective on sustainability. Yeah. So one critical question when talking about sustainability is the question of the ESG data underlying the study. In our case, we needed two types of ESG data, one related to the exclusion, one related to the ESG integration. So on the first leg, exclusionary screening, one difficulty is to capture the diversity of exclusion strategies. We know that different asset owners, managers, different investors have different exclusion strategies. And to take it into considerations, we've considered three different strategies in the paper. The first one, called consensus, is based on exclusion criteria used by the largest asset owners. This covers, for example, controversial weapons, tobacco, coal, violations of United Nations Global Compact principles. Just for information, these principles cover both social and environmental principles. Then we have a second filter, which is related to the EU regulations on Paris-aligned benchmarks. And this second strategy adds to the previous one some ESG exclusion criteria related to climate change, as the name may suggest, and one is related to the oil and the other one to the gas. Finally, we have a third and last exclusion strategy, which is called Sustainable Development Goals. And within this one, we consider a larger set of exclusion criteria, more than 17, that can impact negatively any of the United Nations Sustainable Development Goals and targets. During this presentation, just to remain in time, I will focus only on the results of the Paris-aligned benchmark exclusion criteria. That's why it's in red. But all the results are consistent when applying the other screens. And I invite you, if you want more details, to have a look at the paper that you can download, I think, on the left of your screen. Now, on the other leg, for the ESG integration, many types of data can be used for ESG integration, but the most well-known and used are ESG scores. One of the difficulties for such a study is according to the literature, we know that the scores vary widely across providers. For example, among the biggest, largest companies, we know that the correlation is very low. So to account to this heterogeneity in scores, we had the chance to rely on a unique database provided by ValueCo. So ValueCo aggregates ESG scores from several asset managers for any company. And in this study, we've decided to use only companies where we had at least 5 different ESG scores from 5 different asset managers, so with 5 different methodologies. So this is a way to take into account the fact that there is a lot of heterogeneity into the ESG scores methodologies. That's for the ESG data. Now, a quick word about the samples. We've decided to make 2 different samples, one related to developed Europe, the other one to the United States regions. And for both regions, we have a sample of indices, around 130 for Europe and close from 400 for United States. And we also have a stock level sample of around 400 stocks for both regions. So these benchmark stocks, this second sample, corresponds to the benchmark constituents of each region. The first word based on this slide is you can look at both the score and the weight of harmful stock. And what we can first observe is that there is a significant difference between the regions. In terms of score, the average equity indices weighted ESG score is significantly higher for developed Europe indices. And the opposite is true also in terms of harmful stocks. The weight of harmful stocks in indices is significantly lower than in the United States. And as you can see, the results are also similar when we look at stocks. Stocks were from developed Europe, in average, have a little bit higher ESG scores. Okay, so that was for the methodology and data. Now I will switch to the three main results of the study. So the first question we asked was to know whether indices with high ESG scores are safe from harmful stock. So is there an overlap between the two approaches and the underlying data? So in one word, the answer is no. Maybe if we want to say in two words, it will be not enough. What we can see on this graph, so each point on this graph represents a US index. And on the horizontal axis, you can see its weighted average ESG score. While on the vertical axis, you can see the weight of harmful stocks within the index. Of course, we can clearly see a relation between the two. However, if we focus, for example, on the top 25% indices in terms of weighted average ESG scores, that's the green area on the right of the graph, we can still have up to 33% of the total index weight composed of harmful stocks, which means like that indices with high ESG scores are not necessarily safe from harmful stock. Of course, there is a relation, so they have, in average, less harmful stocks than the other, but they are not completely safe. And as you can know, the do no harm principle is more like a binary principle, and we would like them to be completely safe. So first answer is that, at least at portfolio level, high ESG scores does not guarantee the do no harm principles. So now the next question is whether to know, okay, let's say that we want to apply an exclusion strategy in addition to an ESG integration strategy, for example. How would the two relate, and does the exclusion of harmful stock will impact ESG scores positively or negatively? As you may guess, the relation is not negative, and what we observe is that there is a significant positive relation. So what does it mean? It means that excluding harmful stocks will improve both in the median, but systematically in our sample, the ESG score of the indices. In this case, just as a reminder, when I talk about excluding harmful stocks, the figures I show you are the one with the Paris-aligned benchmarks exclusions, the one that focuses on climate change. But once again, the results remain consistent for the three different exclusion screens. So yeah, as you can see here, for example, for developed Europe, the median weighted average ESG score increased by 0.8 points for developed Europe and by 2.9 points for US. So the main takeaway from this second result is that exclusions and ESG integrations do not seem to compromise each other, and they, on the contrary, seems to be more complementary. Now we can get back to the question similar to the first one, which is to understand whether an exclusion based on ESG scores would remove harmful stocks. So the question is a bit similar to the first one, but now we will treat it on the stock level sample. And how did we do that? We considered for both regions the same number as we have identified as harmful according to the Paris-aligned benchmark criteria. So for developed Europe, we've identified 46 harmful stocks, and for US, 68. And then we've taken the same number of companies with the lowest ESG scores. And as you can see on the graph, the intersection between the two is relatively low. For developed Europe, it's around a bit less than 1/3, which is very low. It's a little bit higher for United States, but all in all, we can still conclude that the overlap between the two types of approaches and the two types of ESG data is far from perfect, and that therefore the two approach seems more complementary. Okay, so that was the three main results I wanted to highlight during this presentation. Now we can wonder, how do these findings translate into practice? What could be the recommendations? I think that the main message here is to say that relying only on ESG scores for ESG integration will not guarantee alignment with do no harm principle in portfolio construction. That does not mean that ESG score cannot be used as a decision metric, but they should be used in addition to another analysis of the do no harm principle respects. However, the good news from the second result is that integrating exclusion in additions to ESG scores will both enhance portfolio quality by answering the do no harm principles, and it will still maintain the ESG performance, and in most of the case, increase it. So that's the two main results. Of course, we have only talked until now about the sustainable dimension of such a strategy. The next step is naturally to anticipate the financial impact of such exclusion. This is a topic that we've covered in a different study that we will be pleased to present next month. But just as a teaser, what the main results of this second study, which is also available on the website if you cannot wait till the next month. But the main result is that applying exclusion either on consensus screen or on climate with the Paris-aligned benchmark screen has a relatively low impact on the financial risk profile, especially when we talk about the tracking error. And what we've seen is that this impact can be further reduced with an optimized reallocation. So this sends like a good signal that it's both exclusion is both interesting from a sustainability perspective, but also can be managed as a relatively low financial risk cost. Okay, so that was the main message. Thank you for your attention, and I will now leave the floor to Jaya.
Thank you very much, Vincent. Thank you for your presentation. Before we move to the Q&A session, I'd like to highlight that all the exclusion strategies presented by Vincent today are implemented on the Scientific Portfolio platform, which means you can load your personal portfolio and scan through it using the various negative screening methodologies. And that means in case some names in your portfolio get flagged, you also have the ability to instantaneously test the financial consequences of enforcing that exclusion strategy you selected, which includes the ability to combine those exclusions with an optimized reallocation, and in order to minimize the financial consequences of that exclusion. If you wish to have a live demo, please click on the link that will be located on the left-hand side of your webinar panel. And I also would like to emphasize that the entry-level standard access to our platform is free, and you may request your free access again by clicking on the link on the left-hand side of the panel. I believe we can now move on to the Q&A session. I will give it a minute or two for attendees to send their questions, although I see some have already sent theirs. Thank you. I'll just wait another minute or two, and I'll let also Vincent address those questions directly.
Yeah, I already see a couple of questions regarding the methodology and data, so maybe I can start addressing them, and in the meantime, feel free to ask more questions. Mm-hmm. So one is about the ESG score database we've used, and whether the aggregate score are from 5 different asset managers or data vendors. So in this case, it's the scores are aggregated from 5 different asset managers. So the database built by ValueCo is really built from the different asset managers for any given company. And we have at least 5 different views, sometimes way more, but we define for the study to limit companies that had at least these 5 different scores to be sure that we could rely on a good proxy when using the median. And I just would like to emphasize on this point that we've also tested the results using, for example, different quartile in the distribution, the first one and the third one, and the results all remain consistent. So it seems that same if we consider, for example, not maybe the worst, but some of the worst ESG scores for any company. This is not. There is still not overlap with the exclusion criteria. So I hope this answers the first question about this ESG scores data. And then we have a second question about the methodology of the Sustainable Development Goal screen. Okay. So there are 2 questions actually, but I will first start with the first one about this specific screen. So I did not really detail it today as I wanted to remain short, but there is a lot of explanation in the appendix of the paper and on the other paper also. But in a few words, what we've done for the Sustainable Development Goals screen is we have reviewed the 17 Sustainable Development Goals, but most importantly, the 169 or 869, I think, targets that underlie these development goals. And for each target, we've first identified whether the target was relevant for corporates, like at company levels. As you may know, if you're familiar with this Sustainable Development Goals framework, not all targets, some targets are more dedicated to countries, to regions, this kind of organizations, and might not be really suitable for companies. So then we have selected, I don't have the exact figures right now, but it's around 70, 75 targets that we identified as relevant for corporates and on which companies can have negative impact. And for each of them, we've reviewed the academic literature, trying to identify whether some specific activities, such, for example, as tobacco, alcohol, or such specific behavior, such as non-respect of, such as discrimination or corruption, might impact each of these targets. And then we made like a review of the available data from ESG data vendors to complete for each criteria a specific variable. And that's how the screen is built. So that's why it's, if you look at the results on the portfolio level, at indices level, or at stock level, it excludes much more companies than the 2 other ones. So it can be considered as a much more ambitious exclusion strategy. So I hope it also answers this first question. And then there is a second question in the same post about the aggregation scores and how do they help address inconsistency among them. So once again, they do not really address inconsistency because there is no way to say that the median score is better in some way or to better represent the true ESG performance of any issuer. However, the fact that we've used consistency checks with different quartile make at least the results robust, which means that the results do not really depend that much on which ESG score you use. That's at least possible to say so for our results. Of course, the inconsistency of ESG scores remain an important challenge for other users in other contexts, whether to choose funds or to allocate your portfolios. Okay. Okay.
Just before you look at other questions, Vincent, I just wanted to add that just following this last question, I wanted to highlight that I hadn't mentioned before that the full paper is available on your webinar dashboard panel, again, via link on the left-hand side. If I know there were questions about the detailed methodologies for some of the screens that, as you said, would be in the appendix. So highlighting that the paper is available on the dashboard as well.
Okay.
Sorry, go ahead.
Yeah, it's another question. So the question is about the impact of exclusion on other metrics such as carbon emissions. So that's not something we've covered in this study. Here, the focus was really on ESG scores, as once again, it's one of the most famous and most used sustainable strategy. But we've made some analysis on another paper on the impact of the different filters we've discussed on one specific climate metric. So as you know, there are a lot, so it might a little bit depend on which one you use. But at least when we use the weighted average carbon intensity, so it means the emissions, in our case, we limited it to scope 1 and 2, divided by the revenue of the firm and weighted average at the portfolio level. What we observe is that for consensus, so the first screen, and for Paris Line benchmark, the one focusing on climate, if you apply them and you just reallocate, let's say naively, the remaining stocks, the carbon intensity will tend to decrease. I don't remember the exact figure, but it's around like 30%, which is quite important. However, when you use the third screen, the one I just discussed before, related to the Sustainable Development Goals, the results are not that consistent, and decrease will really depend on the funds, or on the indices in our case. And so because you also exclude a lot of companies for social issues, these companies might also have very low intensity, and therefore the result at the portfolio level is not always a reduction. Another interesting result we've seen when doing this test is that when you optimize the reallocation to, for example, to minimize your tracking error, which was the goal of the second paper I told you about, we see that the effect on carbon intensity is usually an increase of the carbon intensity compared to the decrease after the exclusion. So I would say that, of course, the result must be taken with cautious, as we have only tested it with one metric, so it will depend on which metric you rely on. But if you apply climate-related ESG exclusion, such as the one defined by the EU regulation, in average, you will tend to reduce the emission intensity in the same way as you've increased the ESG scores. Shaya, I think I cannot hear you.
Oh, apologies, I was on mute. My bad.
Okay,
sorry about So I was saying that I think we have covered all the questions. Thank you very much, Vincent, again for your presentation, and I'd like to thank you all again for your time and your attendance. And I wish you all a pleasant afternoon or morning, depending on where you are. Thank you very much. Goodbye.